How many years have you been in property finance now, Steve?
23.
23. How long have you been in property, Paul?
Going on 18, believe it or not, young whippersnapper.
And I've been in a few years as well. Don't want to say how many.
You've got more grey hairs than us. You're north of 23.
Hello and welcome to Inside Property and Finance Podcast, where we talk all things money as well as finance. And on this episode, we're going to be talking about using other people's money and how can we structure deals to get 100% finance and funding, because we speak to many investors, maybe similar to yourself, and I know my own situation is that if we can leverage funding, leveraging other people's money, then that's going to allow us to put our money into many more projects. The best example I can give, let's say you have £100,000 to invest. If you go and put that all into one property to purchase, you're tying up all your capital in one deal. And a lot of people think that it's advantageous to buy cash. But I'm going to put a different spin on this when I'm chatting with my business partners here, Steve and Paul, talking about different ways of financing deals and how you can still move quickly, because everybody thinks that because you've got cash, you can move just as quick. But you'll be surprised when you look at some of the other funding options that's available to you. And if you're proactive with that, especially financing through private investment, using other people's money, you can move just as quick and using a blend of bridging finance as well as private money. And if you do that, instead of tying all that money up in one deal, you can then spread that across 2 or more deals, which effectively, if you focus on your cash on cash return on your investment, then it's going to make you a lot more money. So why don't we have a chat about a blend of finance so that someone can get 100% funded?
Right, shall I kick it off?
Yeah, let's kick off, Steve.
Go on, Steve.
Let's take a project that somebody wants to do a conversion of a commercial building. It might be an office block right now and they want to convert it into apartments. So some people think that they need to put down 30, 35, 40% of the purchase price from their own money. Well, it's not the case. A development finance lender, if it's got full planning already, might lend you, for example, 70% of the purchase price and then up to 100% of the build costs. But that difference, that 30% plus interest and fees, let's just call it 40%, that can come from private money, and it could be a loan agreement into your company, into your limited company. It could be shares in the SPV, the new special purpose vehicle that you're going to set up for that project. You know, you might have a few shareholders in that project and each person throws in a certain amount, and you might put in as developer a certain amount just to show confidence in your project. So it can come from, a myriad of ways. And that allows people to get into more projects. Some people are just thinking too small and thinking, I'll do this one deal because this one deal makes me a few $100,000 in this period of time. But they could be doing 3 or 4.
Yeah, I see it all the time. Even pulling it back to just buying one property to develop and sell, one house that you're buying for $100,000 and spending $30,000 renovating it to then sell it on. I think so many people focus, and I don't know if this has been your experience as well, it has been mine, so many just focus on their own resources. And for a lot of people, they don't have a lot to get started, So from that point of view, if you've only got so much and you put that into one project, it's almost a capacity challenge, an issue for that person, because they're just thinking about their own money that they've got and being in one project. And my job is to try and get people to think bigger than that. To think, once you put your money to work, what do? Do you just sit there and wait for that project to finish? Well, wouldn't you want to keep up the momentum and get another project? And this is why the sooner someone starts to look at utilising other people's money, then that there. And just to put things into perspective, Elon Musk, right? Elon Musk didn't use all his money to buy Twitter. He could have arguably bought Twitter using 100% of his own money, but he's clever, he's smart, and that's all smart people do, is they leverage and de-risk their own money by spreading it across alternative different lenders or different people who will invest into a project, So from that point of view, you should be thinking about how can I put your money that you've got to best use, but how can you leverage other people's money? But the key to this, and I'd love to get your points on this, is that what you're giving away in return, because you want to make sure that it's going to be profitable for you. And there's some horror stories out there with people giving stupid returns in terms of big percentages, and that's only going to hurt the developer later on down the line.
Yeah, well, I mean, just start with about the should you or shouldn't you leverage money. I think there's how many years have you been in property finance now, Steve?
23.
23. How long have you been in property, Paul?
Going on 18, believe it or
18,
not, young
yeah.
whippersnapper.
And I've been in a few years as well. Don't want to say how many.
You've got more grey hairs than us. So north of 23.
Yeah, far more intelligent though. Now just think about all the guys you've dealt with over the years and think of the most successful ones right now. Don't have to name them, just think of them, yeah? And I'm sure 3, 4, 5 are maybe popping into your head, yeah? The most successful property investors. Now tell me this, how many of those people have done it all cash?
Yeah, none.
None. And that answers it. Like in anything in life, if you want to be great at something, go and look how the best people do it. And I think that probably answers the question for me more than anything. All the people that we deal with, the ones that have done the best, have leveraged money, whether it be institutional or other people's. So sorry, laboured the point a little bit there, but I think it's a good way of explaining it to people who may be looking at getting into property and should I borrow money, and then, bridging finance, it's expensive and things, and then you wanted to talk about investor funds. And
we'll get to the investor funds in a second, because you just touched on bridging finance being expensive, and this has been my viewpoint, and I don't know if it's been the same for you guys as well, is that the way I look at it, because there are some bridging lenders out there that can give you 100% funding, depending on the deal, of course, which we could maybe touch on. But anytime I look at that and I look at the cost of bridging, which is expensive, but it's a lot cheaper than giving away half the project's profits. So the way I look at it is I'm joint venturing with the bridge and finance company, and of course the rates, if I'm going to compare it against a traditional mortgage, of course it's significantly more, but it's a lot cheaper than giving 50% of the profits to someone else. And as soon as you start to focus in on that, then you start to understand two things. One, well, I don't need to leverage other people. I can look at that for a different deal. I can work with this bridge and finance company. They're going to give me access to the funding. I've got little to no money to put in. And if I build a relationship with that bridge and finance company that's got significantly more money than individuals, and they might then give me better rates for the next deal and so forth. So it's a relationship building there. And as soon as you start thinking differently when you're approaching bridge and finance companies, you're going to open yourself up to be able to do way more deals than someone who's just focusing in, trying to fight with little percentages here. I don't want to pay that arrangement fee. I don't want to pay this. For me, what's the next deal? What's the next deal? I'm not getting caught up in just, for me, it's all about building those relationships, getting better funding terms, as well as getting onto my next project.
Yeah, definitely. And some people, going back to the money, their own money thing, they'll look at the money they've got in their savings account. They won't consider the equity that they've got. So there's various ways that we can tap into that equity that somebody has, just to give them more cash to put in the deal themselves.
Yeah.
So
that's one of the things I'm going to just jump in here before we get back into other people's money. So if you're listening to this is the crazy thing. Always get in touch with your broker who specialises in bridging and development finance, because they will unlock so many different finance options for you that will make your head spin. You'll be sitting there thinking that you've got only the money that's sitting in your savings, or you've got equity here, but after a consultation, a conversation with your broker, you're going to realise you've got access to so much more funds, and you're going to be able to move and build a portfolio or get involved in development a lot quicker than you first thought. So just thought I'd jump in there. Of course, head over to expressmortgages.co.uk, and our team of specialists in that area will be able to support and help you with all things bridging and looking at your situation to unlock extra finance. So keep that in mind. So why don't we touch on the other people's money side of things? This is using private investment. Now, the key that I always talk about is to get that money in at under 10%. 10%. Sometimes you can go slightly more, but once you start giving over 10% per annum on returns, you're really starting to get into a slippery slope with not giving yourself much headroom when it comes to profits and being able to pay those loans back.
Well, unless you're prepared to do developments and earn no money out of it, but what's the point in doing that? Because you're giving it all away to other people. I think it's alarm bell ringing when people are offering huge returns. I mean, I'm actually starting to think, are you desperate? Am I going to get that profit? Am I going to get my money back even? And it's not to say that it's always an impossibility. It's not, because we have seen people pay higher returns out but you've got to be very careful. I think we hear it, don't we, where they're offering 20%, 30%, and
We've all done it. I did it in the early days because it's easier to get money and given higher returns, but it bites harder. And it's not until you've went through that yourself, which I did in my mid-20s when I was borrowing money, and thankfully I had enough on the go to be able to pay things and successful projects. But it's scary because you're like, shit. And you soon start to learn, I might as well just sharpen my skill set of being able to find the right people that I can borrow at the certain percentage that's going to allow my business to be healthy and projects to give out more profits. Because the last thing you want to be doing is taking profits from a different project to pay for that one.
Yeah, it's all going to fall down eventually,
And there's plenty of investors out there that would handle let's just say a 4 or 5% fixed return, so like a relatively small amount fixed return, and a share in the profits, so they're getting the best of both worlds.
Yeah, I love that strategy. Like, so one of the strategies I've done in the past, and I tell many people, if you're going to give more than 10% back, make it as a percentage of the profit. So the way that I structure the deal is that I'll bring in their initial capital, let's say it's 100K, for less than 5%, 5% tops. And that's quite hard to raise that money at 5%. However, then you can give them a percentage of the profit that then equates to being more than 10%. Again, you don't want to just blow your brains out and give them lots, but when you do the calculation based on anticipated profit, it's more than 10%. So they're like, okay, so I get that. I'm getting my fixed 5%, but I'm also, if this project overperforms, I'm going to get more than that, but at least they've got comfort of at least a fixed return, and they're going to get that. But at the same time, they can, get that reward. But the good thing is if a project's going to take 2 years, it's not straining the cash flow of paying the loan. It means that the extra shares comes out of profit. So it's a very different way of doing it, and one that I prefer because you can give, I guess, higher returns in those bases.
Yeah, and as an investor, if you're getting the rate of inflation or a little bit higher, most people are pretty happy with that. Obviously, you've got some investors that want to wring the towel out. They want the 20% pluses and whatever, but and there's a place for that in the market. But I think for a lot of people, you've just got to be aware of not giving away too much, and you can blend it like that. I like the idea of that. A little bit of security in the fixed return, and then the rest in terms of performance.
Absolutely.
Yeah, I think you've got to look at the deal as well, haven't you? No one should be sat there saying, "Oh, I want money, and I'm going to pay this rate." And not just the person wanting the funds to go and do the project, but the person giving the funds should know what is it's actually going into, so they can maybe do a little bit of their own due diligence at the same time. And there is actually a place at times where it should be purely profit split. If a project's going to be a long burn where maybe there's planning gain after planning gain needed or whatever, then it's right to do it that way. And I know you're quite right. It's better to only give away 10% than half the profits, 10% on the money you borrow, than half the profits. But sometimes that can work right, not as often, but it can work right that way, to the point where there are actually institutional funders who will fund the whole project up to 10 million quid. You'll pay them 12% on the money that you're borrowing, and then you'll share the profits. And people might say, well, why'd you do that? Well, if that's your only option to get that project away, it's better to do something and earn money than maybe lose the project in its entirety. Or it might be that you've only got so much money, but as well as that project, you can still do another project with the money that you have got. So that there is a time and a place where it should go all to profit share. And if you do have to give away half the profit, it's better than earning nothing. But yeah, if you can blend it together with senior debt or money from, a bridging development company, along with investor money, that's where you keep your cost of finance to a minimum, and you can actually make the more profit in the long run.
Yeah, and when you go back to the percentage returns that you give, I'm just going to share a quick story here because this was the game changer for me. So I met my real dad for the first time 10 years ago, and found out I had an older brother, two older sisters, and my eldest sister, Candy, she's involved in finance in London. And she would be someone that I would chat to a lot and you know, just bounce off ideas and have a conversation. And they're all Jewish, so I'm 46.5% Jewish, and it was fascinating meeting that whole family. And anyway, but I remember at one point, and I was chatting to Candice, and she made some introductions to some key people within the Jewish community, and they took to me very well, especially because my dad, my family, and everything else. And I would show them certain deals that I was working on. And it was at a time when I was offering like 15%, 20% returns on deals, and none of them would take a deal. And I remember speaking to Candice, and I says, look, I thought Jewish people were smart and they wanted to make money. And she's like, well, tell me. And I'd show the deal and I'd talk about things.
Not to stereotype anyone.
Not to stereotype, but I tell you what, very shrewd. And the point proves here when I'm showing Candice the deal and she's like, yeah, that looks like good. I'm surprised. What rate of return are you giving? Between 15 and 20%. She went, there you go. They already think that this is a high risk deal.
Yeah.
Because that's what's deemed of that type of percentage. It doesn't matter what you're saying here. I would be suggesting you offer less than 10% and you'll be surprised at the different approach that people have. They'll still ask questions like anyone would do and they'll look into it, but you'll get more, openness to discuss and look at it and explore if you're managing your rates. And then when I started having that conversation around the 10%, people took me a lot more seriously. And I'm the same. You just mentioned it. If someone's giving you an astronomical return, if your alarm bells are not going off, like you're very naive, unfortunately, and you really need to start exploring and thinking, hold on a minute, what's this person's track record? Have they got experience in doing the thing they're about to do? Have they paid back loans before? Have they done it at this rate of return? Can that project actually provide that level of profits? It's quite scary.
Yeah, it is. You know, as you're talking, three words spring to mind, and it's sustainability. How sustainable is that business model? If you're just paying 25% all the time, 30%, sooner or later you're going to have a project that goes pear-shaped. And relationships are so important. If you want a proper relationship with somebody for the long term, having a more realistic figure percentage works for both parties. And then the third thing, I've forgotten. No. The third thing is track record, and experience, because somebody with experience, to me, that's worth a lot. It mitigates a lot of the risk. So I'm willing to accept a smaller percentage because of their track record.
Yeah, and in this game of properties, as you guys know, reputation is the most important thing. The most important thing. If you end up messing up your reputation, you're going to find it incredibly difficult because the community talks. And I guess I share this here because the whole topic is using other people's money, and those that will be watching and listening to a podcast like this are keen to go and raise private investment. They're looking to get 100% funding. They're looking to do more projects, and I'm sharing these here through own past experiences and what we observe in the market, so that when you go out there to raise the money, understand what other people are looking at and what they are trying to uncover to see whether they should invest with you. And one of the things I always say is that if you speak to someone to get some private investment and for whatever reason you don't get it, then rather than just repeating what you've done with the conversation you have with that person with someone else, because the likelihood is going to be the same answer, learn from that. Is it that you should just go and do this deal first to get a bit more track record? Is it that you need to give a profit share on the actual deal, just to get a track record of doing some developments? Because in the early days, that might be what you have to do. Not everyone starts with a great network, at least I never, of people who are just ready to throw money at you, so you have to start where you start. And the key here is to keep on building your reputation, do more deals, and before you know it, you'll be able to name your own terms.
Yeah, well, you've only got to look at mainstream lenders. So some of them, they won't lend a shilling to someone unless they've got principal experience. And it's one of those things, isn't it? How do you get principal experience if they won't give it to you in the first place? Well, you've just got to be realistic and do a project at a level that an investor or a funder will actually give you the go on it and build up to that level. But again, that's your reputation, isn't it?
Yeah, and you can see from somebody's bio, like their journey. Like there's one developer that I deal with, and he's in the Asian community, he's borrowed off Bank of Punjab, there's other lenders as well. And I know that the rates are going to be higher than Close Brothers in that end of the market. But now he's dealing with the Shawbrooks and the Close Brothers and the lenders that are categorised as tier one. And so your interest rate gets cheaper over time as well. But you've got to go through that journey and borrow. Not every time, but a lot of the times you've got to pay a little bit more maybe in your interest rate. But then once you've got 2 or 3 projects of similar ilk under your belt, like you say, you can name your terms.
Yeah.
But similarly, like we said earlier, if you're the investor and someone's offering 15-20%, alarm bells should be going off. If anyone's listening right now and they're offering 15 or 20%, their alarm bells should now be going off thinking, what am I doing? Because ultimately, if a project's only got X percentage of profit in it anyway, that's just more. Even if you still make money at 15 to 20%, are you actually making as much as what you could be doing? Yeah. You know, so again, you got to test your investor. But I would certainly, coming back to your comment there about doing the pitch, and it's got to be realistic and it's got to be sustainable and all those things. It's so important. You know, who is it that you're getting the money from in the senior debt? If you're blending it, are they reliable? Because if they let you down and you let that investor down, as you said, Paul, your reputation is done. And it's a small world. It is a small world. And you won't be getting any more money anytime soon from other people.
Yeah. And I think that's key, isn't it? That if you go in with the right mindset and the right approach and you're doing your due diligence and, like I have consultants and, experts in their field, because some of the projects we're involved in are bigger developments where there is perceived more risk. And we spend easily over 10K a month just on consulting to not do deals.
Yeah.
Which is wild and hard for people to comprehend. But we look at way more deals than we do. And we'll be lucky if we do 3 or 4 larger scale deals in a year. We'll be lucky. Be lucky. Because for us, and what we're trying to achieve and do, is that we want to as best as we can, de-risk any investment. And if it means that spending money on the initial approach to see if we're going to get planning and see if we have to overcome certain challenges and so forth, like we're prepared to do that and put some money in so that we know that if it gets past that and it's good to go, that we're comfortable about raising private investment if it's required or taking it to lenders and getting support. So, and thankfully with those bigger developments, there's lots of profits in that to absorb those costs. But scaling it right back to just, one property that you're going to buy, renovate and flip, it's amazing how many people who have got deal envy and maybe they've went through a period of not getting a deal and then they just jump on something and then they take a blind eye to some of the red flags and want to force a deal. And because they're using private investment and not using their own money, it's like, I'll figure it out later or whatever. It's a bad move. And it's one of those ones that I would much rather protect my investors' money to put it into something that's safe, that's going to give them that return, rather than putting them in something that's a little more risky. You know yourself, because investors know. They actually know, but turning a blind eye to that risk because it's going to ruin your reputation if that doesn't come to fruition later on. And it does scare me because then they create a vicious circle of having to borrow money from someone else to pay that, and before you know it, you're in a Ponzi scheme. No one knows it, but you're literally what's happening.
Yeah. It's one thing giving fixed returns, stating fixed returns at a high percentage, and a very much different another where you just split the profits. And there's one developer I know who says, I know I could make more money, Steve, if I gave a fixed return like a lot of my pals, but I'm not going to do that because it puts me under unnecessary pressure and I feel I've got to honour that. And some projects do not pay that out because you do enough projects, you're going to have one that doesn't pay as well. So he always puts 5% of the equity in, not the debt. So the debt, for those that are listening, might be the development finance at 75% of the total costs or 70% of the total costs. And then the equity is what you raise from investors. So of that equity amount, he will put 5% into every deal to show he's got skin in the game. Yeah. And then he'll say to them, us as developers take 50% of the profits and you lot as investors get 50% of the profits too, spread amongst you depending on what you've put in.
It's a good point, so if you're going to hand over your hard-earned money to someone to go and do a project, first question, if this project fails, how much will it hurt them? That should be your first question. Yeah. And if the answer's nothing, it's probably not one to Unless you've got some serious PGs and charges on other assets, maybe. But otherwise, it's like.
What was interesting, he said to me the other week, he said, Steve, we've performed particularly well on a project, and we've gone the extra mile, we've put a lot of effort into it, and we're going to get our investors a lot higher return than they anticipated. So we're considering this. What do you think? And he targets projects where the investor gets 20% per annum. So it is on the higher side, but he's got lots of experience, and sometimes there's planning gains. And he said, if we get 25 or 30%, what do you think about a 60-40 split or a 70-30 split? And I said to him, once you get to 25% or north of, I personally think as an investor, a 60-40 split in your favour is fine. Maybe above 30%, a 70-30, above that level. But here's something I would do. Can you give me a stop loss? So at the other end of the spectrum, can you say to me, if the project doesn't perform as well, can you guarantee me the rate of inflation at the CPI? Because I'll take that. And he said, yeah, I'll go with that. So we would forgo our profits if it really tanked, and we'd pay the investor first.
Yeah, I think just with the word you used there, and I just want to bring it up here, is the word guarantee. Because if you're bringing in loan agreements, it's going to be an unsecured loan agreement, and unregulated as well. And you need to be careful with using that word. And it gives me shivers when I hear people and I see it online and social, which I'm like, what on earth? You're not FCA regulated. You shouldn't be saying those things. Yeah. Guaranteed returns. Because you're presenting an investment opportunity, and the word's opportunity. And here's the anticipated and expected returns. And of course, the person who's lending the money has got to do their due diligence, and you've got to present as much information as you can. And of course, if you're presenting your deal, you're presenting it in the best possible light, aren't you? But at the same time, you've got to make sure that you have de-risked it, to be comfortable with borrowing the money. Because if you borrow the money and you feel good about things and you've done your due diligence, some things kind of go wrong, of course, but again, you've done your due diligence, you've de-risked it, you're comfortable with bringing in that money. But just be careful with the word guarantee, because you can't. Technically, you can't. Their capital's at risk. Now, again, we don't want that to be the worst case scenario. We focus on the best case scenario, and that will happen if you've done your due diligence and you're comfortable with the deal and you've done everything you need to do as a developer and an investor.
You're right, Paul. Probably saying, can you give me more certainty and comfort? And maybe if the project doesn't perform as well, the first 8% of profits come to the investors and the rest then go to the developer. And of course, in your shareholders agreement, you can say whatever you want, can't you? So you can make sure it's all checked through properly with lawyers, etc.
Yeah. Well, what I do with any time I borrow money is that I underwrite it. So even though and by the way, that's not a prerequisite to our loan agreements. It's just a prerequisite to my reputation. Do you know that way? Yeah. Because for me, I will never borrow any more. It's just an internal criteria that I've got. And I don't borrow a lot, but when I do, it's I'm talking about from private investment, is 25% maximum of my anticipated profit over the next 12 to 24 months, depending on my projects, because I don't want to borrow too much, so that if one project doesn't go, and thankfully I've got a good track record, but let's say one doesn't go to plan, then I've got plenty of profits in there because I've not over leveraged. Because that there is, for me, is important. Also, what I do, because a lot of the things that I do is in planning gain, I put my own money in to get planning. And once you've got planning, again, it's going to open up. You've de-risked massively. And if I have taken investors in on deals before pre-planning, and when they're taking it, they know the risk. Yeah. They know, by the way, you're getting now this is where a higher return's paid. Yeah. A higher return, over 20%, but they know this is in the basis of getting planning. Now, we'll put an insurance policy in, which can underwrite some of the cost, but there's still a cost there. So people can still lose some money. But take an example as a project just now that I'm about to invest into, and it's been anticipated 200K all-in costs to take it through planning. Thereabouts. I'm just getting firmed up from the architect and all the surveys and stuff. And the conversation we have on a regular basis is we'll know with the first 50K whether it's going to get planning or not. But we're going to have to spend money.
Yeah.
Now I'm prepared to put my money in to speculate because I've got good consultants. We've got a planning consultant who's put a report together. You know, I've got good architects. It's in the local development plan. So there's a lot in favour for it. However, there's still challenges to overcome with planning. So we know, even though it's anticipated 200 grand to go in to get planning on this, we need to spend the first 50 to be sure. And then we're going to go through that process. And once we get planning, it's a different story, because for us, it's more comfortable to go out to get investment at a lower rate because you've de-risked. You know, where's someone coming in on the deal? Are they coming in right at the very beginning? You know, then in that case, it's like, well, let's go in with our...
It's a business venture.
Exactly.
Yeah, it's like, it doesn't matter whether it's property or cars or bricks or anything.
Artificial intelligence.
Artificial intelligence. It's a business venture, and that's the way it should be seen. So people who are often the seed capital in any business get they've got the biggest risk, but they get the biggest rewards. That's not a silly proposition. But what you're saying therefore is that someone coming in on the final 150,000, they might actually put in the full 150, say, and someone else has put in 50. So people's natural reaction is, well, the guy with 150 in's got the biggest risk, but not necessarily, because they're coming in after that initial 50's been spent, which is where the highest level of uncertainty exists and therefore risk.
Absolutely. Yeah. So I think summarising this here, you know, no one should shy away from taking private investment in. I think that for us here, we've just alerted and made you aware of some of the things you should look out for, and you know, in the sense of giving away higher returns, you know, de-risking the investment, doing your due diligence, presenting it in the best possible light, but at the same time, you know, protecting your reputation of what could go wrong here and making sure that you go in with the best intention. And if you do it right, and you've got a number of personal or private investors there that have got money who want to pledge and get involved in deals, and you blend that with bridging and development finance, you can literally fund all your deals going forward using none of your own money, getting 100% funding. And you just need to make sure you get the terms in the right manner that's going to be beneficial for you, because all it takes is one project to give you a lump sum of money. Think about it. You get involved in a project that you put no money in, but a bit of time and effort to go and raise the money, and then you've now got a whole bunch of cash that's came out of a project that you used other people's money to get, to then use that to go into your next project and maybe bigger projects, and just keep on building from the one to the next. So I guess for me, this year again, if you're listening in as an investor and a developer, at Express Mortgages, we work with investors, private investors who bring seed capital into some of these projects. And what I always recommend that you do if you're looking for 100% funding, especially bridge and development finance, which we specialise in here, is reach out to the team. They'll have a conversation with you. They'll look at your own personal circumstance. They'll look at the project as well, ask some questions, so we can put you in the best possible light to go out there to get 100% funding, whether it's with our bridgers and the different finance partners we've got, or tapping into some of the private investment as well. So head over to expressmortgages.co.uk, reach out to the team, we'll look after you. And of course, any questions, any comments, pop them in the chat box below or the comments so we can go in there, respond and answer, and make sure you subscribe to the channel too. So all the best, and bye for now.